Hi, everyone. It's Alyssa Korn with Investors Business Daily, and welcome to Investing Strategies. The online sports gambling market is continuing to expand, and Penn National Gaming is very bullish on the industry's future. Penn CEO Jay Snowden provides an inside look at the strategic initiatives in the casino operators' pipeline. Plus, IBD tech reporter Allison Gatlin has the scoop on the vaccine scene 1 year after the onset of the coronavirus pandemic. From new variants to regimen effectiveness, we've got you covered. And we're getting technical with a breakdown of how the 10-week moving average can be a great tool for your portfolio management toolbox. I'm sharing IBD's take on how to buy and sell using this key level. Investing strategy starts right now. The online sports gambling market is continuing to gain attention, and Penn National Gaming is right in the thick of this growing trend. And joining me now to discuss Penn's strategic initiatives and outlook for the year is Penn CEO Jay Snowden. Thanks for joining me today, Jay.
Happy to be here, Alyssa. Thanks for having me.
So what would you say are Penn's keys to success over the last year? From an investor standpoint, the stock has had an incredible run. So what are your keys to success?
Well, look, the last year, think about, what we've been through. COVID hit about a year ago now in March of 2020, and we were mandated to shut down all 40 of our properties across the country. And so even in your worst sort of doomsday scenario planning around risk management, we just didn't have shut the whole company down for 3 months and generate zero revenue. So it was a scary moment there in March and April. Our stock went from $30 down to $4 and something. And look, at the end of the day, it always boils down to you have to have great people, and you have to have a great strategy, and you have to be able to execute. And so I look at the last year, and I couldn't feel any better about the team that we have at Penn, the partners that we have at Bar Stool. I will tell you that even in those darkest of days in March of April of last year, there was just never a feeling of doubt. There was never a feeling of anyone wanting to throw in the towel or give up. The resiliency that I witnessed firsthand with my team and with our partners at Bar Stool, it was always, we're going to get through this. We're going to be fine. And we just have to get to the next day and get to the next day. And, that mentality and that resiliency, I think, really helped us a lot. And once we were able to start to reopen our properties, initially in Mississippi, Louisiana in May, and then a whole slew of states in June and July, business results were really strong. People had, there was pent up demand, cabin fever to get out of the house and do something that was safe and fun. We obviously offer that in our land-based casinos. And then fast forward to September, and we were able to launch our Barstool branded mobile sports book, Barstool. And Pennsylvania was the first state. We were late to the game, about 15 months from everybody else who were there at the starting gate at the same time. And really proud of what we've been able to do in the first 6 or 7 months being live in Pennsylvania. We went from not having any market share to being firmly in the number 3 spot behind DraftKings and FanDuel. Then we fast forward, we launched in the state of Michigan in January with our online sports book, and then online casino in early February. And then we just launched in Illinois prior to March Madness. And the demand has been very strong. Barstool has a really strong presence in Chicago. So you package all of that up, and things just sort of worked out for us. We were able to take advantage of the momentum we had. We did a couple of capital raises in 2020 to really shore up the balance sheet and give us the dry powder that we needed to be aggressive and opportunistic as it relates to M&A. And so, we're busy now thinking about all the things that we want to do and can do to further cement the strategy and make that moat that we've built deeper and wider than it's ever been.
Mm-hmm. And you talked about the relationship with Barstool, and it's been a little over a year, and that ended up being a very key partnership for you ahead of the pandemic with this big pivot to digital that you really had to pay attention to.
Yeah, we knew when PASPA was overturned, Alyssa, in May of 2018, that this was a real transformational opportunity for the company, really for a couple of reasons. One, we operated in, and still do, in more states than any other gaming company in the United States, and we're up to 20 states now. And when PASPA was overturned, PASPA being the law that made sports betting illegal across the country other than in the state of Nevada. But when the US Supreme Court overturned that decision, it became a states' rights issue. And so this footprint that we have across the US was best in class. And so we knew it was an opportunity for us to do two things. One, monetize the footprint. And we have, in so many of these states, we have multiple properties, and then therefore you have multiple licenses or skins, as they're called in the industry, to operate. So we did an RFP and we ended up finding some really good skin partners like DraftKings and Fox Bet, PointsBet, The Score, since then BetMGM, Unibet. So we've got a number of skin partners. And why that's important is because in order for them to get access in some of these states, they have to partner up with a land-based casino operator. And in return for giving them access, we get rev shares, and in some cases, cash upfront or equity upfront. In the case of PointsBet and The Score, we took equity upfront, and the equity positions, which were originally worth about $15 million, are now worth close to $200 million in PointsBet and The Score. And then step two was, how are we going to, really pivot the company and lead with digital for the long term, because that's where the industry is going as it relates to both sports betting and online casino. And we knew that we had the footprint. We know how to operate both sports books retail and casino retail. What we were missing, of course, was a brand to lead with. From a sports betting perspective, we have great casino brands across the country, but no sports brands. And we also needed access to the audience that is, most highly correlated to sports bettors, which is the younger men aged 21 to 35 years old. Most of our land-based casinos skew a little bit older, 40s, 50s, 60s, and tend to skew more female than they do male. When we met Dave Portnoy and Erica Nardini and Dan Katz, Big Cat at Bar Stool, we both told the story before, but you knew in the first meeting that there was a deal to be done. We didn't have lawyers and bankers in the room. So we really got at what matters to you. And what mattered to them was leading with their brands. We wanted to do that. And I think others that they had talked to wanted to partner with Barstool, but maybe didn't want to go all in on the brand and lead with the brand. Whereas I'm Boston based. My wife's from Brockton, Massachusetts. We've been familiar with Barstool for 15 years. And I think the brand is really an amazing story of what it was when it launched in 2003, 2004 to what it is here in 2021. Because of COVID, we actually haven't been able to do one of the things that Dave and Erica and Dan and myself, my team, are most excited about, which is to activate the audience of Barstool on-prem at our casinos and inside our sports books. We've converted all these sports books to Barstool branded, but we have capacity limitations because of COVID. And so as those capacity limitations continue to be relaxed or eventually go away, I think you're going to see the last part of this story, and maybe one of the most compelling parts, which is to bring that audience to our facilities and really give them, a reason to engage with the audience at Barstool, the personalities, have great fun at the events and golf tournaments at our golf courses. So we've got a lot of great plans. And I think COVID in some sort of odd way really acted as an accelerant to our strategy. I think it was going to take us longer to really educate the investor community that this is a pivot that we knew we could make and we were ready to make. And COVID just moved everything along and advanced it. Maybe over the course of 6 months, it would have taken us about 3 years. It just accelerated the whole digitalization of the industry and of the company faster than I think anybody was prepared for.
Yeah. And speaking of the industry, can you talk to us a little bit more about the competitive landscape here and how you feel Penn is positioned within that from both the online sports gambling perspective and those physical casinos?
Yeah, our competitive landscape, Alyssa, has changed quite a bit. It was always typically the, core brick and mortar casino operators, Caesars, MGM, Boyd, Red Rock. And now it's sort of the set has really grown, and we consider the DraftKings and FanDuels and Entain, some of the large European operators, Flutter, those are very much a competitive set as well. And then also because we have this media asset at Barstool, we definitely look at the media landscape and competition there as it relates to podcasting and sports media, sports content. So it really has evolved. I think you're going to see further convergence happening over the course of the next couple, 2, 3, 4 years, you're going to see media and sports and gaming continue, I think, to come closer together, and throw tech in there as well. Sometimes people don't see the forest through the trees around what this might look like 3 years, 5 years, 6 years from now. It's like this mad arms race to spend who can spend the most money. And everybody talks about handle market share as all anybody cares about month to month. And stocks like ours, which are, there's high beta and you can move 20, 30% in 30 days, no problem. I think that we really need to take a step back and look at what are the strategies, what makes each strategy unique. And we believe ours is truly differentiated because we have this fully integrated and compelling media asset that is part of our digital offerings. And one thing I know is that regardless of the industry, and certainly today more than ever, Alyssa, is that content wins. And we know we have the best content around sports betting in the space, and it's not even close. Sky Bet in the UK, I think, is a great example that had a fully integrated technology and media strategy with their sports betting. And, early on, they were mid-single digit market share, and over time it became high single digit, low double digit, mid-teen, high teen. And you look today and they're the number one player, or certainly in the top three on any given month, any given year from a market share standpoint. We feel like we have the right strategy, the right business model, and we have structural advantages around the skin agreements I mentioned to you, where we don't have to pay for access in 20 states like everybody else does. And then we actually have rev shares coming in because we have skin partners in all of these states. So, and our customer acquisition costs, because of that relationship with Barstool, we don't have to spend to the levels, not even close to what anyone else is doing. This is not an industry, in my opinion, like credit cards or mobile phones, where the switching cost is actually quite high because you use your phone for everything and it's linked to your accounts, or your credit card is, you're doing your streaming services or all go to the same credit card. Like, that's pretty high switching costs. And I think that in the US, people are going to end up just like in the UK, having 3 to 5 sports betting and online casino apps on their phone. And I think whoever has the best products and the most compelling content, which we think that we're best positioned to do, is going to win out in the end.
So needless to say, you're pretty bullish on the company's outlook. How do you see the relationship with Barstool evolving over the course of the next several years? Because it sounds like that's where the future is, and that's what's really driving the growth that you're expecting to unlock in the next year.
Yeah, we have a great relationship. It's long term. The way that we structured this, Alyssa, is that Dave and Erica and Big Cat and many others at Barstool, but let's just talk about those three. They're all signed up for 5 or 6 years, the three of them, and we're already in conversations around what does the next sort of extension look like, because I think everybody's really pleased with how things are going so far. And we acquired Barstool to be Barstool. And honestly, if anything, it's what are the investments that we can make, whether it's capital, it's resources, it's just the energy within the two companies to help them grow, because the bigger Barstool gets, the wider the funnel becomes from a customer acquisition standpoint for Penn and Barstool. And there's so many different ways to engage that audience and to monetize over time. And I think sports betting and online casino is just one or two of those reasons, but or sort of opportunities. But you think about alcohol and packaged goods, you could see, One Bite frozen pizzas and Walmarts and Targets across the country. You could see us owning our own sort of product line within alcohol through Barstool over time. There's so much we can do. And so I think the partnership, as good as it is today, is just going to get stronger over time because of the brands and how we can really help one another. Like we talk about this all the time, that, Penn by itself maybe had a value of X and potential of Y, and Barstool by itself had value of A and potential of B. But then you put it together and you just blew through those sort of ceilings that you might have felt previously. So I think that there's so much more that we can do to support them and make their platform bigger. And there's so much more that Barstool can do, like the on-site, on-prem activations, to make our core business healthier and bring younger audiences to our core business. So as good as it is today, I think that you're going to see this evolve in really strategic, healthy ways over the coming years.
Thank you so much, Jay, for your insights today. I definitely learned a lot about what's ahead for Penn. It sounds like there are a lot of exciting things in the pipeline, and we'll definitely be watching. Thanks again.
All right. Thanks for having me, Alyssa.
All right, and coming up next, we're getting a one-year update on all things coronavirus with IBD medical sector reporter Allison Gatlin. That's right after the break.
Good morning, everyone, and welcome to IBD Live.
Okay, here we go.
It's now been more than a year since the coronavirus pandemic hit, if you can believe it, sparking an intense race for vaccines, treatments, and answers. Now that a number of vaccines are rolling out, what do investors and consumers need to be aware of? Well, IBD tech reporter Allison Gatlin has a solid grip on the vaccine scene and is here to share all the details. Allison, thanks for being here today.
Absolutely. Thanks, Alyssa.
So there are a number of vaccines that are rolling out right now. Give us a lay of the land of what's going on in the vaccine front.
So we have 3 vaccines that are actually authorized for emergency use in the United States. We have the Pfizer-BioNTech partnered vaccine. We have a vaccine from Moderna. Both of those were authorized for emergency use in December. Those are based on messenger RNA technology, which is very interesting. It actually teaches the body how to create a specific type of protein structure that will in turn prompt an immune response. We also have a vaccine authorized from Johnson & Johnson that uses a different technology, and that one's a little bit different. It actually uses 1 shot versus the Pfizer-BioNTech vaccine and the Moderna vaccine, which use 2 shots.
Okay, so we've also been hearing about these new variants coming onto the scene now. How do the new variants impact the effectiveness of these vaccines? And should people be worried about that?
There are several variants of concern that experts are interested in right now. The South Africa variant, the variant that was first discovered in South Africa, is of the most concern because it does make vaccines slightly less effective. What it does essentially is there's a mutation. It's called E484K. This mutation makes it harder for the antibodies to grab on to the virus itself, which in turn makes it more difficult for vaccines to target. The key here is that the vaccines can still work. They just might be a little bit less effective. However, when you're coming from a very high point of efficacy to begin with, the Pfizer-BioNTech vaccine in clinical testing was 95% effective. The Moderna vaccine was 94.1% effective. So when you're coming from a very high level of efficacy, it's still going to be very effective, just at a lower degree. Now, that being said, these companies weren't actually able to test their vaccines against that specific variant because it hadn't really become an issue at the point that they were running their clinical studies. Now, Johnson & Johnson and Novavax were able to test their vaccines against that variant. So their vaccines in clinical testing have shown 57% efficacy against the South Africa variant for Johnson & Johnson. And it was 60% effective for Novavax. So that's still very high efficacy, when we're talking about a variant that we still don't fully understand.
And you mentioned the 1 shot versus 2 shots. And I think a lot of everyday people out there are wanting to know if they have the choice, what's the best vaccine to get?
So you likely won't have a choice. It's going to be what your provider, what the county, what the vaccination site you attend is administering. It likely won't be up to you. That being said, all of the vaccines that we have on the market in the US and several of those that are coming up that are likely to gain authorization in the United States are very effective against death, serious illness, and hospitalizations. And that's the key point here. You might still contract COVID-19, but you likely won't die. You likely won't be admitted to the hospital.
Well, there is one vaccine that is has a little bit of a controversy associated with that, and that's AstraZeneca. So, can you break down what controversy is around that, and maybe dispel some of the associated misinformation with that?
So there's been a lot of hiccups with the AstraZeneca vaccine. It's partnered with the University of Oxford. The vaccine ultimately proved to be 76% effective against symptomatic COVID-19 in the interim US phase 3 study. Before that, however, the Data and Safety Monitoring Board questioned whether AstraZeneca had included outdated information in its interim analysis of the study. So, AstraZeneca ran its analysis again, making sure that it used the most up-to-date data, and found that it was 76% effective, which is still very, very effective, even if that is lower than the Pfizer, BioNTech, and Moderna vaccines. There's also been a question of blood clots related to the vaccine, and that's caused a number of countries in Europe to suspend their rollout of that specific vaccine. And that's unfortunate because these claims are unsubstantiated at this point. The European Medical Agency and the World Health Organization have both said to continue using this vaccine. So at this point, that vaccine actually is not authorized for emergency use in the United States. We are still waiting for more data, but that could be coming down the line in the near term.
So, taking a step back here from an investor standpoint, all of these companies that have been working on these vaccines and treatments, what does the future hold? How much longer is there going to be this intense focus on coronavirus moving forward?
I think we're going to see more headlines, more data, and more treatments, vaccines, diagnostics in the COVID-19 realm, just as long as this pandemic continues to persist. The question here is, how long will we see variants? And experts still don't know. We don't know if there is a finite number of ways that the coronavirus can mutate. And if there is a finite number, will the companies be able to come up with vaccines and treatments to target all of those variants? So right now, it's really still up in the air how long we're going to see COVID-19 in the world, and how long we're going to be looking at coronaviruses in general, because this COVID-19 is caused by SARS-CoV-2, the virus. That's just one form of coronavirus. There are others that can move from animals to humans, and experts are still waiting to see and understand whether this can happen again.
Well, we are definitely going to keep tabs on the vaccine rollout and how these different variants play out. And you are on top of all of this. And thanks so much for explaining everything in such an easy to understand way, Allison. I appreciate you breaking all of that down for us.
Thanks, Alyssa. Thanks for having me.
And after the break, I'm sharing IBD's take on a key tool for any position trader's toolbox, using the 10-week moving average to buy and sell. That's next.
IBD Digital gives you access to our premium content.
The best of Investors Business Daily.
A team with decades of experience serving up actionable investing content, a sophisticated tool set to facilitate your own deep dives, and educational resources that will give you an edge in the stock market. We have over 100 years of stock market data, all focused on one thing: what makes a winning stock.
We're taking the guesswork out of investing. Subscribe now to build a better portfolio and make more money in the stock market.
If position traders want to manage their risk at proper entry points and have a clearly defined level at which to sell, the 10-week moving average can be a great tool for your portfolio management toolbox. Whenever you're assessing stocks to buy, you should always have your exit strategy in place at the time that you're making that initial purchase. As a general rule, you want to make sure you're limiting your losses so you don't sink your entire portfolio on one trade. Holding and hoping for the best and freezing up if the trade starts to head south is not a sound strategy. Now, pullbacks to the 10-week line early in a leading stocks run can be logical areas to not only add to an existing position, but to initiate a new one. That's because many top stocks will find support at this level and stay above it as they make their big moves, making it a compelling entry point and a great guide for when to get out of the trade when the stock eventually breaks support at that level. So when using the 10-week line to calculate the size of a position, first seek out stocks that meet IBD's fundamental and technical screening criteria and are within 10% above the 10-week line. And the closer to that level it is as the stock is moving higher, the better. Now, you also need to have a set amount you're willing to risk for each trade you make. Let's say that's 1% of your portfolio per trade. Sounds pretty reasonable, right? So for a $100,000 portfolio, that works out to $1,000 of portfolio risk for each trade. Okay, so let's say you've identified a strong stock that typically gets support at its 10-week moving average, and the proper entry point is 10% above the 10-week line. In this case, risking that $1,000 would lead to a position size of $10,000 or 10% of your portfolio. We get that 10,000 number by dividing the $1,000 you want to risk by 0.1, or the 10% decline you'd be willing to hold the stock through for it to come down to its 10-week line. In that case, risking 10% on the trade rather than 7 to 8%, that stop loss that IBD typically recommends, might be beneficial. That's because if you sell when you're down 8% and the stock goes down another 2% but finds support at its 10-week line, you would have been shaken out of the trade while the stock moves higher without you. And now this is exactly what happened with Taiwan Semiconductor back in September 2020. The stock broke out of a flat base and was within 10% of the 10-week line as it was clearing the buy point. And you could have even used an earlier entry here to get a better price. While the breakout was bullish and accompanied by heavy volume, the stock quickly pulled back. It fell 7% below the traditional buy point and closed slightly below its 50-day line, and that's the 10-week line's cousin. But by the end of the week, the stock was able to find support at the 10-week line and bounce higher, preventing those who were using the 10-week rule from getting shaken out as the stock was just trying to rev up. Now, let's talk about using the 10-week line as a signal to get out of a stock after it makes a big move. IBD's research shows that once a leading stock has a decisive break of the 10-week line, that means the stock's move may be over, or at the very least, it may be entering a base building period, which means you're probably better off putting your money to work elsewhere while the stock consolidates. At the time of the decisive break of the 10-week line, you don't know how much more the stock will fall or how long it will take for it to get back above the 10-week line and start to trend higher. Now, we consider a decisive break of the 10-week line to be a close below that level of 2% or more on a weekly basis. So if your stock edges below the 10-week line early in the week, you can wait until close to Friday's close to see if the stock managed to find support there by the end of the week, or if need be, to make your final sell if the stock does have a decisive break. So let's take a look at this concept in action using Taiwan Semiconductor once again. Now, those who purchased Taiwan Semi at that September breakout could have used this 10-week line to keep them in the stock for a gain as big as 70% by February 2021. But then in early March, as many tech stocks took big hits, Taiwan Semi closed 3.6% below the 10-week line, and it has yet to move higher. Another example, Tesla. The electric car maker was no doubt one of the hottest stocks in 2020, but in late February of 2021, Tesla had a sharp break of its 10-week line. That was a clear sell signal for many long-term shareholders that it was time for Tesla to take a break after its huge run. So there you have it, the 10-week line. Great for position sizing to manage risk and a support level that can act as a key sell signal for a winning stock after a big run. Thank you all for watching this episode of Investing Strategies for Investors Business Daily. I'm Alyssa Corum. Hi there. Thanks so much for watching Investing Strategies on our YouTube channel. If you want more executive interviews and analysis of key trends to watch, make sure you hit the subscribe button so you can stay up to date.